Welcome to Stock Mo. You know what's wild? Most people are sitting on the sidelines right now, convinced they missed everything. They watch the market bounce, they watch certain stocks run, and now they're telling themselves the opportunity is gone. But here's what's actually happening. There are still several companies trading at levels that make absolutely no sense given what their financial results are showing. And I'm not just going to throw names at you and tell you to go buy them. That's not what Stock Mo is about. What we're going to do today is walk through the actual thinking process, the real framework that separates investors who consistently build wealth from the ones who keep chasing the wrong things at the wrong time. Before we get into the specific names, I want you to hit that subscribe button right now if you haven't already. We put out videos like this regularly, going deep on real investment logic, not hype, not noise. Hit subscribe and turn on notifications so you don't miss what's coming next, because the next few months are going to matter a lot for your portfolio. Now, let's get into this, because before you even think about a single stock name, you need to understand the environment you're operating in. Think of it like a weather check before you leave the house. You wouldn't plan a picnic without knowing if there's a storm coming. The same applies to investing. There are four major factors that set the stage for everything else, and right now all four of them are flashing green, which is exactly why this conversation is so important and so timely. The first factor is the economy itself. Is the job market holding up? Are consumers still spending? Is there real activity happening in the real world outside of stock charts? Right now, the answer is yes. It's not a booming party, but it's stable. Unemployment is reasonable, consumer spending is happening, and businesses are still functioning in a way that supports growth. You're not walking into an economy that's about to fall off a cliff. That matters because even a great stock in a collapsing economy is going to struggle. The second factor is market valuations overall. Now, when we talk about the S&P 500 or the Nasdaq as a whole, are stocks priced like they're in a bubble? Are people paying absurd premiums just because they're excited? Right now, the answer is it's a little stretched in certain areas, but not in a way that screams danger across the board. There are pockets of value. There are stocks that have been unfairly beaten down. And that's where the opportunity lives right now. The third factor is profit growth. This one is huge. Companies across the board are currently reporting their quarterly earnings. And what we're seeing is that profit growth is strong, not weak, not flat. Strong. When companies are making more money quarter over quarter, year over year, that creates a foundation for stock prices to move higher over time. It doesn't happen instantly, but it happens. And when you combine strong profit growth with a stock that's trading at a reasonable price, that's the setup every experienced investor looks for. The fourth factor is interest rates. Think of interest rates as gravity for the stock market. The higher they are, the more they pull stock valuations down. Right now, we're sitting at rates that are historically very manageable compared to where they've been in past decades. This is not the early 1980s where rates were near 20%. We're at a fraction of that today, which means the gravitational pull on stock prices from rate pressure is relatively light. That's good. That gives stocks room to be valued appropriately based on their actual earnings potential. So, all four of those boxes are checked. The environment is okay to go. That clears the runway for us to start looking at specific companies. Now, when we evaluate any company, the elimination process is the key skill. Most investors try to build a case for why something is a buy. I want you to flip that. Try to find the reason to say no. Try to argue against it. Because if you go through a company trying to prove it shouldn't be in your portfolio, and you genuinely can't find a compelling reason to eliminate it, that tells you something important. Most companies you run through this filter will get eliminated fast. That's actually a good thing. It means you're saving your capital for the ones that really matter. The two biggest reasons to say no to almost anything are valuation and competitive moat. Valuation simply means are you paying too much for what you're getting? If a company earns $1 per year and you're paying $60 to own a piece of it, you better have a very strong reason to believe those earnings are about to explode. Otherwise, that's just a bad deal. And moat is about whether this company has something that protects it from competition. Can a competitor show up tomorrow and take their customers? Or does this company have something sticky, something that makes customers come back, makes it very hard for a rival to displace them? Let's run through Nvidia first. And I know a lot of people have been watching Nvidia for a while, and some feel like they missed the move. But here's the thing, when you strip away all the emotion and just look at the numbers, Nvidia still makes a compelling case. Their profit margins are enormous right now because demand for their GPU chips from artificial intelligence data centers is not slowing down. The companies building the biggest AI infrastructure in the world, we're talking about the Metas, the Alphabets, the Amazons, the Teslas, they are continuing to pour money into chips. That demand is real, and it's documented in their own earnings calls. Nvidia's profit growth year over year is running at around 64%. And revenue is growing at a similar pace. That kind of growth rate changes the math on valuation completely. When profits are compounding that fast, a price-to-earnings ratio that looks high on the surface starts to look very different when you project forward a couple of years. The moat is real, too. They have deep software integration with their hardware through their development ecosystem. And that is not easy to replicate. Could Nvidia face more competition down the road? Yes, but right now, the data is and the data says this is a company worth paying attention to. Now, here's how to think about actually putting money to work. Once you've decided you want in on a company, there are basically 3 levels of how you can express your conviction. The first level is simply buying shares. This is the foundation. If you like a company and you want exposure to it, you buy shares. Simple, relatively low risk compared to other approaches, and if you hold long enough in a solid company, historically, you tend to do well. The second level is selling cash-secured puts, which is a way to potentially buy shares at a lower price while getting paid a premium in the meantime. This approach requires more capital and a bit more understanding of options, but it's a beautiful strategy for a company you genuinely want to own. The third level is buying call options, which is the highest conviction, highest leverage move. If you're wrong, you can lose your entire premium. The key with call options is to give yourself time, not 2 or 3 months, but closer to 2 years. When you buy time and you've done the work on valuation and growth, you dramatically improve your odds. Now, let's talk about Meta, because this might be the most compelling opportunity on this entire list right now. If you look at what Meta is currently trading at versus what a reasonable intrinsic value calculation suggests it should be worth, there's a significant gap. We're talking about a company that is running a business most people already understand: advertising, connecting users with advertisers, driving people to content and products, and collecting revenue every single time that happens. It's a model that has shown incredible durability, and Meta has a level of scale in social media that is genuinely very hard to replicate. 2 billion plus people using their platforms every single day is not something a startup can compete with overnight. And yet, the stock is trading at a discount to where the fundamentals suggest it should be. Profit growth is strong, revenue is growing. They're investing heavily in capital expenditures right now, which some investors are nervous about, but that investment is what positions them to keep growing. And when you get a business this predictable, this sticky, with this much user engagement, at a valuation that doesn't fully reflect those qualities, that's the type of setup that long-term investors have made fortunes identifying. If you're finding this useful, drop a comment below and let me know what stocks you're watching right now. It genuinely helps shape what we cover next, and I read every single comment. Also, share this video with someone in your circle who's been asking about the market lately. You might be doing them a real favor. Now, let's talk about some names that a lot of people are excited about that I think deserve serious scrutiny, because understanding what not to buy is just as valuable as knowing what to buy. Nike is a great example. On the surface, it looks like a beaten-down brand that could recover. The stock has gone down consistently for years, and some people think that makes it a bargain. But when you look at what's actually happening with Nike's earnings, you see a troubling trend. Profits are declining, revenue isn't growing the way it needs to for the price you're paying. And the competitive environment in athletic wear and apparel has never been more crowded. There are dozens of brands fighting for the same customers. There's no real pricing power. There's no moat in the way Nvidia or Apple has a moat. And when you're paying a significant premium in valuation for a company whose earnings are going the wrong direction, that's a combination that tends to lead to continued disappointment. The stock might bounce at some point, everything bounces eventually, but sustained long-term appreciation comes from profit growth. And that's just not present here right now. Costco is another one that constantly comes up. And I want to be really precise here, because Costco is a genuinely good company. People love shopping there. The membership model is smart. But love for a company and love for the stock are two completely different things. When you look at Costco's current valuation, you're paying over 50 times trailing earnings for a business that's growing profits at around 13% per year, and revenue at about 8%. 13% growth is decent. It's not bad. But when you compare it to other companies available in the market today that have significantly faster growth and are trading at lower valuations, Costco just doesn't compete in the portfolio context. The price you pay matters enormously. You want fast profit growth and fast revenue growth at the lowest possible valuation entry point. Costco right now is the opposite of that ratio. Then there's Hims and Hers, which has generated a lot of excitement because of the weight loss drug space. Revenue was growing fast for a while, and that caught attention. But when you dig into the actual earnings picture, the profit growth story falls apart. The company spends aggressively on advertising to acquire customers, and that spending eats into any margins that might otherwise exist. There's also a real competitive moat problem here. Amazon has entered the space. When Amazon decides they want to be in a market, small and mid-sized players in that same market need to have a serious answer for how they survive. The current valuation asks you to pay a very high multiple for a company that isn't consistently profitable and faces escalating competition. That combination is very hard to make work. Salesforce is a more nuanced one. The numbers on earnings per share growth are actually good, around 23%, and revenue growth is positive, too. The valuation is more reasonable than some of the other names we just talked about. So, why the hesitation? The honest answer is the moat question. In the current era of artificial intelligence, it's genuinely uncertain. Software businesses that were considered sticky and essential 5 years ago are now facing real questions about whether AI-native tools can do the same job faster and cheaper. That uncertainty around the competitive position makes it harder to build the level of conviction you want before committing capital. It's not a definitive no, it's a strong question mark. When you have a strong question mark on the moat of a company, and there are other companies where the moat is crystal clear, you go with the clearer picture. Which brings us back to why Meta stands out so much in this environment. The moat is clear, the growth is documented, the valuation relative to that growth is attractive. The business model is well understood, and has been stress tested across multiple economic cycles. They're investing for the future in a way that might depress short-term results, but positions them for sustained dominance. And the scale advantage in social media and digital advertising is genuinely one of the most powerful in the entire corporate world. When you stack up all the qualities, predictability, growth, valuation, moat, competitive position, Meta keeps rising to the top of the list. TSM, which is Taiwan Semiconductor, is also worth attention in the semiconductor space for investors who want exposure to the chip cycle without the same concentration of risk as a single product company. They're the manufacturing backbone that many of the world's most important chip companies depend on. As AI infrastructure spending continues to ramp, the demand flowing through Taiwan Semiconductor's facilities remains very strong. Here's the framework to remember. Start at the highest level. Is the economy okay? Are market valuations reasonable? Is profit growth healthy? And are interest rates in a manageable range? When those boxes are checked, you have a green light to go hunting for individual opportunities. Then you drill down, and you try to eliminate each candidate. Can I find a moat problem? Can I find a valuation problem? Most things will be eliminated quickly. The ones that survive the elimination process are the ones that deserve your deeper attention, and eventually your capital. Sized appropriately, and diversified enough that no single mistake can do serious damage. The companies that are making the most sense right now: Nvidia for AI infrastructure dominance, exceptional profit growth, Meta for unmatched social media scale and deeply attractive valuation, and Taiwan Semiconductor for its structural position in the global chip supply chain. These are names where the elimination process keeps stalling. Because the case for quality and value keeps holding up. If you want to keep building this kind of thinking, make sure you're subscribed to Finance Hype. Like this video if you got value from it today. It genuinely helps more people find this content, and we're trying to get this kind of real analysis in front of as many people as possible. Share it with someone who's been trying to figure out where to put their money in this market. And drop a comment telling me which of these stocks you're most interested in, or which one surprised you most. I want to hear from you. The opportunity right now is real, but it requires the right framework to see it. You have that framework now. Go use it.